the classroom, to the city, to the world, we have taken what we've learned in class and are now applying it into a real-world simulation provided to us by the Chicago Quantitative Alliance's Investment Challenge. My name is Donald Kerr, and I'm a current sophomore at Pitt Business.
My name is Daniel Martin, and I'm a senior.
My name is Nikki Messina, and I'm a sophomore.
My name is Nick Belezis, and I'm a senior.
My name is Ryan Fall, and I'm a senior. Because this is the University of Pittsburgh's first attempt at this challenge, we chose a team-based approach. We believe using a team-based approach combines everyone's knowledge and insight and leads to the best results. In addition, each member remains equally informed as to the performance of our portfolio. We believe that strategies that have a proven track record of success are the best in the construction of a portfolio. Our beliefs were inspired by the work of James O'Shaughnessy, owner and manager of O'Shaughnessy Asset Management. O'Shaughnessy has conducted comprehensive back-tested research on several portfolios consisting of single and multi-factors. Price to momentum and price to book generated the overall highest returns. In addition, we created our own backtest dating back to 1985, which consisted of 1 and 3 months price to momentum and price to book factors. We chose a 1, 2, and 3 month holding period based on the short time horizon of our investment portfolio. We also performed a backtest covering the period of 2013 to the present. We compared the results of these two backtests to see how they differed. Overall, the results were pretty similar, generating similar monthly returns and similar standard deviations. Because of this, we chose to monitor our positions and adjust them accordingly rather than make adjustments on a specified time frame. For our stock selection, we used a scanner that fit our criteria. Our scan included market cap minimum of $10 billion, price to book of less than 2, beta between negative 1.5 and 1.5, and 1 and 3 month price appreciation. We chose price to book between 0 and 2 because this comprises of the 20% of stocks with the lowest price to book. In addition, we chose a beta of negative 1.5 to 1.5 so that high or low beta stocks did not affect our portfolio performance. Our long positions were determined by selecting those that had the highest 1 and 3 month price appreciation, and our short positions were selected by those that had the lowest price appreciation. For our position sizing and selection, we chose to equally weight our portfolio for our balanced results. We selected around 20 long positions and 20 short positions. We selected these positions based on the top performers based on the results of our scan. In addition, by choosing 20 positions, this met our portfolio criteria and this minimized transaction costs. Now we will move into performance of our portfolio over the investment process.
We couldn't use a capital asset pricing model to determine risk and return expectations because we didn't know what positions would be in our portfolio. Instead, we used the results from our backtests. The 1985 backtest produced a 1.3% monthly return with a 5.94% standard deviation. Going from 2013, the backtest produced 0.87% monthly return with a 3.82% standard deviation. We chose to take the equal weighted average of these two tests, resulting in an expected return of 1.09% per month with a standard deviation of 4.88%. The performance of our portfolio over the first month returned 0.09% versus the benchmark of 0.2%. Top performers in our portfolio came from the consumer finance and healthcare industries. Our stocks contributed 4.28% of our return compared to 0.49% from the market. Bottom performers came from the electric utilities and metals and mining industries. Much of this can be explained by the decline of 8.2% in the utilities index from November to January. This summarizes the performance of our portfolio over the first month. As you can see, our return is lower than the benchmark, and our risk is slightly higher than we would expect after 1 month of holding our portfolio. Over here we see our factors that contributed to our performance, and more factors that contributed to our performance over here, specifically sectors. In addition to these factors, the S&P 500 return of 5.6% contributed greatly to the negative performance of our short positions over this time period. We chose this benchmark because this represents about 95% of the positions in our portfolio. As a result of this performance, we decided to sell poor performing positions and replace them with new ones based on our scan. We realized that we were heavily weighted in utilities, so we decided to sell off some of those and replace them with new financial stocks. We chose financial stocks because they had achieved recent positive price appreciation due to the financial sector returning 9.02% over the time period. Over the next month, our portfolio achieved a 1% return overall versus a benchmark of 0.34%. Top performers were now bank stocks, mortgage REITs, and healthcare. Our stocks contributed 2.4% return compared to 0.47% from the market. Bottom performers were still electric utilities and metals and mining, and a lot of this can be explained by the decline of another 4.4% in the utilities sector and 6% decline in the metals and mining sector. This represents our performance from November up to February. As you can see, our return is now beating the benchmark with our risk slightly lower than it was in the previous month and lower than expectation. The industry factors still contribute overall to our negative performance, while our stock selection contributes mostly to our positive performance. Yet bank stocks now being the number one positive contributor to our performance, while electric utilities remaining the number one negative factor. Moving to our portfolio performance versus expectation, by now we would have expected a return of approximately 2.2% and a standard deviation of approximately 9.6%. Our actual results, as mentioned, is a return of 1% with a standard deviation of 6.54. This lower return is due largely to the poor performing sectors, as we've mentioned. In addition, this lower standard deviation is due to the low market volatility that was experienced from November to the beginning of February. Moving on to our performance versus our competition, out of 51 teams, we have achieved 13th place with an absolute return of 1.13%, a Sharpe ratio of 0.21, and an alpha of 1.85%. Our beta is 0.15, which was within the parameters of the competition. And these numbers are as of February 14th. Here we have a representation of our top and bottom holdings for both our short and long positions. For our long positions, you can see that 4 out of the top 5 are bank stocks. For our bottom longs, you can see that 3 out of the 5 are energy stocks, which we've mentioned have been performing poorly lately. For our short positions, these stocks are mostly energy and real estate stocks. As we've mentioned, energy stocks have been doing poorly, which is good for our short positions. In addition, the real estate sector has also been doing poorly, which is also good for our short positions. Our negative performers on the short side include bank stocks, which have been doing very well lately, leading to poor performance on shorts. Our outlook moving forward is to continue monitoring our positions and sector performance. We'd like to see how the market reacts to the recent increases in volatility before making any decisions. In addition, before selling off some of our positions in utilities and metals and mining, we'd like to see how they perform over the next few weeks, considering that they have recovered from their recent declines, with utilities returning 2.8% and metals and mining returning 8.6% over the past week. Moving forward, we'll scan for new stocks that meet our criteria and make adjustments as accordingly.
Thank you for listening. And on behalf of Pitt Business, we extend a special thank you to the CQA, our faculty advisor, Kathy Foodie Malice, as well as our CQA advisor, Rob Swanson.